G'day, and welcome back to Shares for Beginners.
Businesses that I own, there's a whole dozens and dozens, hundreds and hundreds of staff working full-time for my benefit. Getting out of the way. Let them do their thing. And if they're good at what they do and there's good dynamics with the business, that will just bear out over time.
That's Andrew Page from Strawman, arguably Australia's leading online investment club. It's all about its members and how they analyse and choose which stocks to invest in. Remember, I have a listener survey at sharesforbeginners.com/survey. As I was putting the final touches on this episode and rolling it in glitter, while listening to some fine disco remixes from Joey Negro, I received this note from Greg W. Greg asked, "A lot of your people say, do your own research. The problem I have is, I don't know where to start with said research. What kind of information should I be looking for, and where to find it?" That's a great question, Greg, and I hope that this episode helps to answer it. Dive into Strawman and see research in action. You'll see the kind of information you should be looking for and where you can find it. I usually try and edit episodes down to around 30 minutes, but because Greg doesn't mind a longer episode, I've kept it a bit longer. I try to do what you, the listener, asks for. So, let's hear from Andrew and where to start with research. Okay, Andrew, so you started at CommSec originally, you were telling me. How was that?
Yeah, well, it was really interesting for a couple of reasons. I had no formal financial qualifications, having completed a degree in microbiology of all things. And it was also in the tech boom, so late 90s, where everything with .com attached to it, share prices were going crazy. Perhaps not too dissimilar to what we're seeing today, in fact, in a lot of ways. But it was a trial by fire and very much in the deep end. This was also at a time when online broking was becoming a thing, and CommSec really is sort of the first major player in that space.
Because they were the first major player, weren't they?
They were.
There's a plethora of choices these days in online broking, but they were the pioneers, weren't they?
They were, and the best advantage that they had wasn't necessarily one of technology, but it was one of branding. But, you know, in the early days, it really had nothing to do with understanding finance or investing. We were simply just taking orders on the phone, processing.
So you were one of the phone jockeys?
I was one of the phone jockeys.
Yeah.
In fact, the very first job was just quoting share prices. People would ring up and say, "What's BHP?" It was really interesting. It was really wild, and it taught all the wrong lessons because it was that crazy, rampant bull market where everything was just going nuts. So to me, as a wide-eyed young guy, I was just thinking, "This is great. You know, I'm going to make a fortune." And to me, I relative to what I had at the time, I did, you know, but I was making good money not by doing anything smart. It was just the rising tide phenomenon. And of course, you fast forward and it's a predictable outcome. You know, that whole sector of the market crashed and any profits I'd managed to generate went with it. So it was an incredibly valuable lesson, not just in terms of how that industry worked, but how the sort of the psychology of markets and all of these things. And it really prompted again, coming from a science background, I was sort of very much accustomed to sort of thinking in terms of evidence and proof. And this is an industry where there's not a lot of good academic rigor behind a lot of approaches that you see in the market.
Really?
Well, there's a lot of great stuff out there, but I mean, anyone just has to sort of Google, you know, how to invest in the share market, and you come across all kinds of sort of crazy things. But even at that sort of corporate level, there was a lot of approaches. We're going to wander into sort of ideological territory here, but you know, approaches that I would sort of deem to be very ill-founded and very poor supported by evidence, and very much sort of based around speculation and, for want of a better term, gambling. But it's a super sexy space. Hope springs eternal. Brokers make their money when you trade, not by when you sit on shares. So there's a very strong incentive to encourage that kind of stuff. So anything that it enhances that, whether it sort of be stop loss, orders or intraday trading strategies, or you know, anything like that, they are going to have an incentive to encourage you to do because they make more money. And I'd argue strongly that, you know, it's probably the less you trade, the better you will do.
I just want to go back because you just mentioned they're coming from a scientific background. You thought there was no rigour, or you felt that there was no rigour in that space.
Yeah.
What are some of the things that you felt weren't rigorous and that you were able to use your scientific background to apply more rigour?
I'm always reluctant to go down this territory because we're instantly going to make half your audience very angry because we do get into sort of these.
They're beginners. It's okay. They're not going to get angry.
Look, there's a lot of people who feel very strongly on these topics, and I guess I'd start by sort of saying you have to do what you feel is right, and you have to go on a process of discovery and feel what's right for you. But to answer your question, and with all that disclaimer out of the way, I think one of the real areas of pseudoscience in this kind of area is technical analysis, charting. I'm not a fan, and it's not something that I've just decided against. It's one of the things where, again, I really made an effort after that period to sort of try and dig into investing approaches and look at ways that seem to be well supported and the rest of it. And here's something that sort of I couldn't find any evidence for that to work consistently. I mean, the market is a probabilistic space. You can have any kind of crazy technique and it's going to work sometimes, but there was nothing like that. And there was also, particularly working for a broker, I mean, you're handling a lot of accounts there, and Lord knows I never saw anyone who could consistently make that work over time. Now, a lot of people will disagree with that. There'll be a lot of people out there who swear by it, and good luck to them.
Yeah, there are a lot of people just love it.
A lot of people love it.
Yeah.
And I think the appeal of it comes because it's easy, relatively. Now, you contrast that with a more fundamental approach that I'm more inclined towards, which requires understanding business models, understanding a lot of economic concepts, having to have a good appreciation of accounting, financial statements.
It's a lot of hard work.
It's a huge amount of hard work.
Yeah.
And even if you get through all of that, you then got this sort of emotional sort of discipline and fortitude that you need to sort of allow these things to bear fruit. Whereas charting, particularly, again, we're in this era where everything is software is just growing strongly. The old guys did it on pen and paper. Now you could do it on a software package, and it's going to do all the charting for you. So you would have all these indicators that would just say buy or sell, and something that just basically flashes green or red is much easier to do. Again, with a probabilistic endeavor like investing, you are going to get a false negatives and false positives and stuff all of the time. But I'm talking about something on a statistical significant basis over multiple different market periods and environments that sort of tends to consistently work. I've not found much satisfaction in that pursuit.
So am I correct in assuming that you believe that eventually the share price will reflect the underlying value of the company?
Absolutely.
Right.
And you know what? I think that's a really great way of summing up. And that's a Buffett quote, is that the business performs well, the share price will follow. And you don't have to take that on faith. I mean, you look at any company, pick one at random on the ASX, and look over a meaningful period of time, so 5 years, ideally longer, 10 years, and look at the share price. And if that share price has gone sideways over 10 years, I'd bet you a large sum of money that earnings have gone nowhere in a 10-year period of time. Now, there'll be periods where earnings aren't going anywhere, but the share price could be flying up or flying down. Earnings could be falling and the share price could be going. So crazy sort of things happen because it's a sentiment-driven machine in the short run. But when you look at it over a broader period of time, there is a perfect correlation, almost perfect correlation. And likewise, you look at the real success stories over the long term, Cochlear or CSL or any of the share price follows the earnings. So to me, it just became really apparent that if I could focus on companies who I felt I had a good or a realistic chance of trying to roughly gauge where earnings were headed over, say, a 3 to 5 year sort of plus period, I put the odds in my favor significantly. Now, if you're like me, pretty much any time you buy a share, it falls the next day. probably falls a lot the next day.
I thought that was just me.
No, it happens all the time.
Okay. But listeners will be pleased to hear that. So don't hit those stop losses?
No, to forget. Oh, man, we could get into stop losses. I think that it's such a distraction, and we focus so much on this ticker symbol and these daily. We forget that we've actually, again, it's so boring, for want of a better word, but it is. We forget that we're actually buying a little chunk of a company. Companies don't change day to day, generally speaking, but the share price will change a lot. And a lot of that will be driven by what happened on US markets, what's happening with commodity prices, what's happening with interest rates, things that are not unimportant, but aren't really the key determinant to the long-term success of a business. When you take any one of those sort of concepts, macro and economic sort of ideas, and you and I can debate where we think the Australian economy is at, where it's sort of headed over the next few years. Undoubtedly, where it does head will impact most businesses on the ASX. But it doesn't say much about their long-term earnings power and the true intrinsic value of that business. And if you get that part right, it kind of doesn't matter what happens in the short term. I've been lucky enough to have some really great long-term investments. And I can tell you that without exception, all of them underperformed in the first at least few months that I held them, in some cases years. And it was a roller coaster ride. But as the business delivered on expectations and the fundamentals started to outweigh the sentiment, it really started to bear fruit. And the pendulum swings, and that is where you make your money. The great thing about that too, Phil, is that you don't have to, once you've done your research, once you've understood the company, you don't have to do much. I have all of our family's money in the market and in our business, but I probably trade a handful of times a year. I'm a very inactive trader because the businesses that I own, there's a whole dozens and dozens, hundreds and hundreds of staff working full time for my benefit, getting out of the way, let them do their thing. And if they're good at what they do and there's good dynamics with the business, that will just bear out over time. And not only that, you avoid transaction costs, you avoid tax. In fact, when you do sell, you get that capital gains discount for holding for 12 months, and you allow this phenomenal thing called compounding to take effect. And compounding is just the most amazing thing in the world, but it's not evident over short periods of time. Compounding isn't a thing over a 12-month period, 2-year period, you need to extend that out for that to really, really sort of reveal itself. And when you look at the great investors and you look at the great success stories on the market, it's not for the guy who may have bought and sold, made 10% here and there. It's the person who bought Commonwealth Bank at $6 and popped it in the bottom drawer. It's the person who bought, Cochlear when it was at $50. Now, that's not to say it's a set and forget. And people like to sort of talk about, buy and hold being dead, and it's an unthinking strategy. It's a case of buying with the intention to hold, keeping your finger on the pulse, absolutely selling when you've realized that you've made a mistake, not because the share price didn't trend the way you thought in the short term, but because you misunderstood a key aspect of the business. Absolutely sell, get out. But unless there's any broad material change to your core investment thesis or to the inherent value of the company and relative to the price on the market, don't do a damn thing. There was an academic study on a large online broker in the US, and they went through all of these accounts to looking for the best performers. They were looking for various things, but one of the surprising things that came out of it was the cohort that performed the best were from inactive accounts where the person had died. So essentially deceased, but the shares were still there in the account. And markets went up, markets went down. When they sort of looked at it later on, these were the people that performed really well. And the people in there fiddling and sort of getting in their own way were the ones that just didn't. And I think that speaks volumes. Most of us have to work, right? Most of us don't have the luxury of just having millions of dollars that we can just sit around idly investing on a day-to-day basis. So we're pretty busy in our lives. And if you're adopting an approach which requires you to sit in front of a screen for 5 hours a day or 6 hours a day between 10 a.m. and 4 p.m., doing this, doing that, it's a full-time job. And when you sort of I sort of say it to a lot of my mates who are very active, and they're more traders than investors. It's like, they might have a good year, and you sort of say, well, what did that actually work out to on a per hour basis? I know for some of my mates, they would have been better packing shelves at Coles. If you want to talk about the effort put into it. Yeah, you made money, but what was that per hour? And by the way, what was the stress and emotional turmoil that it was involved?
How many cigarettes?
And whiskeys did you have to drink to sort of, calm your nerves?
And then get up at 6 a.m. and do all your research, or even 4, 5 in the morning to do research before the market opens. I know I've seen these.
And you're looking at things that have no import. What the US did overnight, or what tweet Donald Trump sent out. I mean, you tell me what impact that is going to have on the fundamental earning power of Cochlear over the next 5 years. Mm-hmm. Nothing.
Yeah.
Virtually nothing. And we are easily distracted, like small children, like exciting things. But the exciting things are the unimportant things.
We're like the cats following the lasers.
It's exactly what we are, It's exactly what we are.
So tell us about Strawman. Why did you start Strawman?
It's essentially an investment club. There's a lot of buzzwords with fintech and all of this stuff around, but it's an old-fashioned investment club. And there's a huge amount of value in that. And the idea is really just bringing together a host of dedicated private investors to collaborate, share ideas, and as the name suggests, to challenge ideas. We think the best way to improve an investment thesis is to challenge it. Not because we want to have arguments. The internet's full of arguments. Ray Dalio, big US fund manager, calls it thoughtful disagreement. And it's about talking to people who have a different perspective to you, or have different insights, different experiences, can bring something to the table and help broaden your understanding of a business. The trouble is that, traditionally you'd have a few people in your club. You might sort of meet around a dinner table one night a week and sort of talk it through. We wanted to do this online and sort of get a much bigger club. And the challenge with that was sort of having the mechanisms in place to make that a feasible sort of proposition. But we felt that there was a real gap in the market there. There's other online forums out there. I would argue there's two major problems with them. One is they're extremely noisy and cluttered places. You go there and, there's a lot of activity. But there's
not very user-friendly, I find, some of these things. It's very difficult to navigate and, what are you looking for? You want to find something on a company and there's a million threads to follow.
There's a million threads and they're all just pretty much in chronological order. And don't get me wrong, there's some great contributors there. There's some phenomenal contributors there. But if you sort of arrive on the scene, it's like, well, which thread do I read? How long do I have to go sort of through that? Get rid of all the guff. People just saying, hey, why is the share price up today? Anyone else holding this? It's not adding anything to your insight. So we felt that there could be a big improvement in the organization of those insights and information. So one of the key things that Strawman does is we just have one page for every company. And anyone can post what we call a straw. It's kind of like a tweet or something. It's a concise insight or perspective on a company. But then we open that up to community endorsement and peer review. So you can vote on those kinds of things. So when you arrive at Strawman, you'll see the most highly endorsed posts there. They also age and date and stuff as well. So we try to keep it current. We try to make sure it's peer reviewed. Anyone can still say anything. We're not trying to silence or censor anyone in any way, shape or form, but we're trying to give a user a better idea of what are the most well-regarded sort of insights. The other problem we think with a lot of online sites is that there's no accountability. So we've all got these random usernames, and who's behind that? And someone's speaking very forcefully on a particular stock on whether you should buy or sell. Well, who are they? Is this someone that has any track record? Is this someone who has any authority? So you don't have that on other sites. So one of the things that we do on Strawman is that we rank people. You can make recommendations. We'll track that against the market. You can make you can post valuations, you can post insights, and that's all ranked. And it's not because we're an elitist group, but it's to give users the ability to sort of, when you see someone contributing, that you can say, hey, wow, this guy has really delivered some great insights. He's well regarded by the community. His recommendations tend to perform pretty well. I might hear what he has to say. There might be someone over here who's making a lot of noise. A lot of people disagree. Everything they touch turns to mud. Maybe they're not worth doing. And the other thing which was not intentional, but has been a really great thing that's emerged from this, is that it's kind of Strawman's a tool that's kind of like an online investment diary, which I'm a huge fan of, which is this idea of writing down why you're going to buy a share. I mean, you know what it's like, Phil, you're barbecue and someone says, oh, you know, what should I buy? Or more often will be, I bought XYZ. You go, great, why? Oh, because it's going up. Well, once you pick into it, you realize often actually there's nothing behind this other than something that's very speculative or something that's very flimsy. So we're saying post your thoughts online and open that up to scrutiny, not because we want to embarrass you, not because we want to make fun of you, but because we think that there's an intrinsic value in you doing that yourself. When you're forced to specify what you think the reasons are for buying a company, when you're buying something, you are specifically saying that it's cheap. The market is wrong. This thing needs to be higher. Well, how much higher? If you're buying BHP, well, what do you think it's worth? And why do you think that's worth? Now, these are hard questions, and there's no exact right answer. But the very process of thinking about it and writing it down and committing that in a public forum will make you a much better investor. So our claim is that by doing that, you're helping yourself as well as the community, because it's once you go through that process, if you realize that, oh man, actually, now that I've put it on paper, it doesn't seem as solid or reliable as it did, it will prompt you to dig a little bit deeper and maybe build up that conviction. Or even better, it might help you avoid making a terrible mistake.
Because you might just miss something as well.
Totally.
You totally miss something.
Yep.
And it's really interesting that you say this, because I've had a couple of fundies on, and this is the kind of thing that they do in their meetings. They come to their meetings and they all have a thesis on particular shares and companies that they think are going to do well. And they've then got to defend that in a meeting. And it's like your peer review in Strawman. And it's giving you the kind of tools that fund managers are using to assess whether they're going to invest in it.
Your investment thesis is either right or wrong. It's as simple as that. So, I want to buy Afterpay because I think it's cheap. I'm right or wrong, one way or the other. Time will tell. Now, there's two ways I can figure out whether it's right or wrong. I can wait, and the market will eventually tell me. And I'm talking beyond the short-term sort of volatility here. It's like, when the fundamentals really sort of weigh in and sort of conclusively prove that you were right or wrong. You can find out by putting your money at risk, or you can find out by discussing with other engaged investors. So when I've put my thoughts out there and you sort of see other people coming up with other perspectives, and it forces me to think that I'm wrong or, have a lot lower conviction, I really welcome that. That's fantastic. People sometimes a bit apologetic, like, oh, I'm sorry, I didn't want to sort of attack your idea here. No, thank you. Thank you for proving me wrong, because if you didn't...
That's valuable information.
I'd much rather have a bit of a bruise to my ego than lose money on the share market. So, yes, please, if I am wrong, I want to know. Unfortunately, investing is a very male-dominated space. All the organizations where we just, it's 90% male to 10% female. And guys are very ego-driven. They're very confrontational, and all these sort of attributes that actually are just really terrible for investing. In fact, there's a lot of good studies that show girls are much better investors because they lack all of these sort of male flaws that we have. But you've got to get over that and get over yourself. It's not about ego. It's about investing prudently and sensibly. And if you can lean on the experience of others. The other thing that I think that's really valuable as well is that everyone is going to bring something to the table. So I used to work for an organization that was a sort of a high net worth investment club. And we'd had people in there who had no experience on the share market, but they may have owned a manufacturing facility for the last 20 years. They're going to know 100 times more about manufacturing than some 27-year-old analyst for ComSec. I think they are. Now, maybe they don't know about discounted cash flow or, sort of the nuanced sort of highfalutin finance ideas. But they're going to offer you an incredible world of insight. And next to them, there might be a lady over there that's spent, 30 years in the healthcare industry. She is going to give you incredible insight. So when you sort of network all of these people together and people contribute in areas that they do have expertise, it's not that one person has to be the oracle of all knowledge here, but when you sort of sum that up, you get something that's really bigger than the sum of its parts. And it's it's really powerful.
The checklist for investors.
Yes.
And this is great information for the audience as well. So can we go through it? So,
sure.
Okay, we've got, I've just transcribed the questions that you use as a checklist for investors. And the first one is, do you understand the business?
Yes. So first thing to say here is I blatantly stole this off Warren Buffett.
It's always about Warren Buffett. It's all you hear about.
Oh, man, when you've got someone who's been doing it for over 50 years with such incredible returns, you pay attention to what they say. And there's a few times he's sort of been interviewed or he's written in his annual report sort of about their general process. And Buffett sort of comes from this approach of investing is easy but not simple. Simple but not easy, sorry. And the idea here is that the big ideas, they're very, very intuitive. They just make a great deal of sense. There's a lot of work you have to sort of do to backfill and support all of these kinds of ideas. But the very first idea is, do you understand the business? And
what's it actually doing?
It sounds stupid to say it out.
People don't understand.
Phil, I can't tell you the number of times people give me a tip and then you say, oh, interesting. What do they do? Oh, something to do with computers. Man, if this wasn't on the share market, if you were just like a multi-millionaire thinking of buying this thing outright, you'd want to know what the hell it does, wouldn't you? And I'm not just sort of saying categorize its industry. It's no good saying software or retail or mining. What's their business model? What are the profit drivers here? What are the dynamics? Is this a high volume, low margin business? Is this something that has lots of recurring revenue? Is it very cyclical? Is it capital intensive? Does it need a lot of money to sort of maintain, or is it a very capital light business? And so again, this is where it's sort of, you start getting into the nuance, but that is the most fundamental of questions. If you can't explain to a 12-year-old accurately, not necessarily technically and in great detail, but accurately what a business does, you've got no business investing in it.
Okay,
so understand the business.
Excellent. Okay, so the next point in the checklist is: do you trust management? Is there any way of ascertaining that?
So management is critical. Unfortunately, it's very hard to gauge. No one puts out a presentation that says, I am a crook and incompetent. That doesn't happen. And even the incompetent crooks have gotten to their position because they do have certain skill sets that have gotten to where they are today. They're often very slick. They're often very good communicators and the rest of it. But
sociopaths sometimes.
Sometimes, unfortunately, the share market is littered of examples of people out there feathering their own nest, telling the market what they want to hear. They weave a wonderful story. You have to remember as an investor that every company has a good story. If it didn't have a good story, it never would have been able to list and raise funds in the first place. Now, that story may become bad over time, but they all look good. They all have decent forecasts. They're all trying to tell a story. So you have to be skeptical, not cynical, and you have to do your best to sort of figure out, who are these people? Are they trustworthy? Are they capable? So there's a couple of things that you can do this. Like all things in investing, it requires a lot of reading. What was said over the last few years in investor presentations at annual general meetings, and how is that matched up with reality? Now, even the CEO has no idea what the future holds, but in broad strokes, have the things that they expected come to light? Do they have a sensible strategy? Is the strategy flip-flopping and changing every 6 months or so? When mistakes happen, and I don't care what company, and the best companies in the world are going to have difficulties, they're going to make missteps. But when that happens, do they take ownership of it? And you'll get a real sense of it. I think one of the people talk about this next part a lot, which is for good reason, which is, do they have any skin in the game? It's good. It's sort of good to talk a good game, but if you don't hold many shares in the company, it says volumes. Or you're selling shares, it sells volumes. The person who's sort of got a material holding, and I don't mean they just got issued a bunch of performance shares. I mean they've bought on market with their own money. That's a material amount to them, so that it would hurt if it lost. That speaks volumes. And
you can find that information quite easily, can't you?
ASX announcements are all there. You go to the annual report, it'll tell you exactly how much they hold, what options. The other one is I'm really big on this idea of he whose bread I eat is song I sing. And it's this idea of incentives. And
what was that quote again?
He whose bread I eat is song I sing. So it's basically saying, your master is the one that provides your your livelihood type thing. And
who's paying the piper?
Yeah, exactly. So it's kind of, it's a question of sort of looking for incentives. Unfortunately, a lot of remuneration consultants have done a great deal of damage over the years in terms of things that seem good at a high level, but provide real perverse incentives for senior management. And they'll often have a lot of short-term incentives to hit particular earnings or sales targets. And there's a lot of clever accounting and often very perfectly legal things that you can do to move things around. And it shifts the focus from, I would say the main role of a CEO is capital allocation and sort of long-term strategic thinking. But when you're just trying to sort of massage the last quarter sales figures to make sure that you get your bonus, you can do that.
And you can see that, can you?
Yeah, you can see exactly. You can see, here are the performance rates, and these are the conditions under which they vest. It's all in the remuneration report, in the annual report.
Yeah.
Legally, it all has to. No one reads it, by the way. Well, very few people do. But it's a wonderful. And this isn't about people being evil or anything. This is just people being people. If you put me in charge of a company and you say that if you can increase earnings by 10% this year, we're going to give you $1 million. I'm really going to try and do that, right? That's what I want to do.
And I guess founder-run companies.
Founder-run, yeah.
Yeah.
These people, they started the business. By the time it's gotten to the ASX, it's already had a great deal of success, and they generally have a huge amount of shares. It's hard to sell shares, that many. If you own 40% of a business, you can't sell that easily. So they have a much bigger incentive to think longer term and really create that value. And you can even look to at things like the actual salary that they're on, versus sort of the incentive payments. And again, you don't have to be an expert for this kind of stuff. You'll read it and you'll get a sense of, this he or she is going to really have a strong inducement to do X, Y, and Z. And is that in line with long-term strategic, sensible thinking and wealth creation for this business?
So what are the risks?
So this is huge. So all of us have a bias in investing on focusing on what can go right. I think you need to spend as much, if not more time, asking what can go wrong, because things will go wrong, and you need to sort of be able to. The person who thinks of that in advance has a huge advantage. A lot of people in the market react to news.
I heard actually a great term last night.
Oh yes,
a pre-mortem.
A pre-mortem. Oh, I love that.
Yeah, it's great, isn't it?
Because then, if it happens, You've thought it through. You sort of game theoried it out. If X was to happen, what does that mean? So, I don't know, pick an example with BHP. Well, one risk is that commodity prices could fall. Well, how much damage would that do? Well, what's their cost of extract? How much does it take? It's all in the annual report, right? All this stuff's there. How much does it cost to take a ton of iron ore out of the ground? And what can they sell it for? And what's that going to do to their profits? Moreover, is there something that is realistic? Well, commodity prices are going to fluctuate. I guarantee you of that. You can't. Anyone saying, "Oh, geez, I didn't expect that." That's crazy. It's going to happen. So not only do you have to think about what can go wrong, but you have to sort of tease apart the difference between what you might call a structural issue, big problem, versus a cyclical temporary issue. So retailers, they're going to have a tough time in a recession. They just are. Doesn't mean they're a bad business. It just means as an investor, don't expect perfectly smooth earnings growth. You're in a fairyland if you think that's going to happen. If you're Maya and you run a department store, and that business model is dying and is under phenomenal threat from the internet, well, that isn't something that's just a temporary, inevitable, to be expected cyclical phenomenon. That is, wow, this business might not actually exist in 10 years' time. And that is a much more difficult, thorny problem. So think about it. Everything that can go wrong. Is this company zoomed out at a broader scale, moving in the right direction, and does the price accurately sort of reflect that view?
Okay, the balance sheet. Is the balance sheet in good shape?
Yes. So that's another massive one.
What is the balance sheet?
So the balance sheet, you've got three main types of financial statements. The first is the income statement. How much money did you make? What are your expenses? What's the profit left over? And that tends to be the main, for obvious reasons, the focus of a lot of investors. How we value shares depends on the profitability of the business. It makes a great deal of sense. The balance sheet looks at all of the assets, all the things that are worth money that the company owns, and its liabilities, all the things that it owes, accounts payable, debt, these kinds of things. And the difference between the two is what we call equity, which is another way of saying net assets. So companies can do what we can do as individuals. So I could go and take a huge loan out from the bank, and I could go put it on a horse. And if that horse wins, well, I only have to pay back what I borrowed, but I get all of the profit from those borrows. So I get these huge leverage returns. Wonderful. But if it loses, or, I can not only lose my money, but I can lose all the money that I've borrowed, and now I'm in a whole world of trouble. And it happens all the time on the market. And most investors don't look at the balance sheet again until it's too late. So look at things like, well, how much debt do they have? How much cash do they have? If they did have a couple of difficult years, could they survive? The businesses that go bust and delist, almost, not always, but almost always, it's a debt-related problem. The GFC was a great example of that. A lot of all companies virtually had a terrible time of it, but the companies that they weren't beholden to any lenders and had plenty of cash in reserve, they weathered the storm. Not only did they weather the storm, but they actually emerged much, much stronger because all their idiot competitors who weren't as prudent probably went out of business, or they had the chance to buy them at fire sale prices. So for companies with very, very strong balance sheets, these periods of disruption actually long-term end up being a wonderful thing. They gain more market share, they lose competitors, and they're there to fight another day.
Okay, and then the final question is, what price is a fair price?
Oh, it's huge.
So sure it is.
At the end of the day, no business on this planet is worth an infinite amount. And most businesses are probably worth more than zero. So a fair value is somewhere between those 2 points, zero and infinity.
I'm glad we've narrowed it down.
We've narrowed it down. So we're at a good starting point. So the way of thinking about what's called intrinsic value or fair value is it's just the total value of all the money that a company is ever going to earn in its life. And we just adjust that by a discount rate because $100 today is worth more than $100 in the future. So if a company's going to earn $10 million in 10 years' time, well, I'm not going to give it a $10 million value today. So I discount that all back. But that we can define intrinsic value perfectly. We can never calculate it perfectly because none of us can predict the future. But what people need to do when they're looking at a company is sort of trying to work out a price that is, and a fair price is one that is going to give you a decent return over time. Assuming the share market closed tomorrow and all you got was the cash flows that this business generated. But I'm a big fan on sort of being generally right again as opposed to specifically wrong. There's some really good rules of thumb that you can employ here. If I think Woolies is an interesting example at present. It's a $37 share price. Woolies is a great business. Yeah, it'll be around for decades to come. Great business, no question. Pays a great dividend. It's delivered incredible wealth for shareholders over a long period of time. But I should have looked at it before I said this, but the price to earnings ratio, the price of the company relative to its profit, is something like 27 times. Now, this is a business that, as I say, a good one, it's probably going to go between 3 and 5% per year at best. It's not afterpay. It's not going to grow at 20% per year. It's just not, and that's no criticism on the case. It's a very mature business. So I could probably say for these kinds of businesses, again, interest rates will sort of muck this up a little bit, but it's in the current environment, maybe a PE of 18 to 20 is far more sensible. So the higher the price I pay, the harder it is it's going to have an inverse impact on my future returns. The business is the business is the business. If I buy Woolies at $1, I'm going to make a fortune. If I buy it at $100, I'm going to lose all my money. What point between there is sensible relative to the earnings capacity of the business?
Okay, so we just talked about price-earnings ratio, and we have just discussed this on the podcast before, but just for someone who's just come into this podcast and this is the first episode they've listened to, this is one of the most common numbers that you're going to see, when you go and look at the value of a company.
Yep.
And it's
really easy at a high level, but again, like all of these fundamental ratios, context is the key word here. It matters. I've got shares in a company whose PE is 200. Now, the average of the market long term is about 16.
So that's what you're looking for. Like in a traditional sense, something with a PE of 12 is really good value.
Yeah.
Something with 6 is really good value.
Insane value.
Yeah.
But plenty of people have done their dough by buying companies at a PE of 6. You're using last year's earnings or an inaccurate forecast of this year's earnings for the denominator, for the E part here. So these are what are called value traps. They look cheap because the ratio is so low, but when the future comes along and says that those earnings were really not they weren't apparent, they didn't appear. If earnings halve, your PE doubles. Right? And so all of a sudden you thought you were buying a PE of 6 and actually you were buying a PE of 12. And even though that sounds cheap, it's probably not for a company that's losing, whose profits dropping by 10% every year. To take the other example of a company of a PE of 200, sounds ridiculously expensive. But if this is off a very low earnings base, they've just tipped into profitability, passed through an inflection point. They're growing their earnings at 30, 40% per year. It doesn't take many years of growth for that PE to come right back down. So again, context matters here. And PEs and dividend yields and debt to equity ratios and all of these sort of fundamental measures are really great rules of thumb, but don't rely on them alone. Put them into context.
So tell us about Strawman. How do people get welcomed into the Strawman community?
You just sign up. It's as easy as that. Strawman.com. Create an account. Have a look around. As I say, we're about 15 months old now, but we've been really, really thrilled with the response. We've now got well over 4,000 users on the platform. We welcomed the last 1,000 users in half the time we added the previous one. We got venture capital backing a couple months ago as well, so we've got a lot more resources, and we are doing some really cool things. We're actually right now working on a new scorecard system. So before you could just recommend a company, now we're actually going to give you a play money portfolio. You can actually position size, and you can do a lot more really cool things. So yeah, we're super excited about it, and we're only as good as our community. So if you're the kind of investor that wants to collaborate and connect with other investors, and you want to do it in a really sort of safe, friendly and encouraging setting, we'd love to have you on board. It's more than finance. I've got companies that are in, they're doing remote censoring, other companies that are doing some really cool stuff in the healthcare space. So it's well beyond just these numbers and spreadsheets and that. You get to learn. So it's just really fascinating and interesting. And I'd really encourage people to really throw themselves into it and just to read and to learn as much as you can. It's a process that will never stop. Doing it for 20 years, I'm learning new stuff all of the time, making mistakes all of the time. But you find that like anything, any endeavor that's worthwhile in life, it requires a bit of effort. And like anything that's worthwhile in life, the more effort and practice you put in, the better you will be. And the rewards are great. Again, I'm not saying get rich quick, but if you can compound your wealth 10% a year, it doesn't sound like much. That's phenomenal. That is so phenomenal. And you can have a lot of fun on the way.
Andrew, thank you very much for coming on the podcast. It's been a real pleasure talking to you.
Thanks for having me, Phil. It's been great.
Shares for Beginners is for information and educational purposes only. It isn't financial advice, and you shouldn't buy or sell any investments based on what you've heard here. Any opinion or commentary is the view of the speaker only, not Shares for Beginners. This podcast doesn't replace professional advice regarding your personal financial needs, circumstances, or current situation. Thanks to Christopher Soulos for music production with that special Greekalicious flavour. Remember, music always flows, even when the money